All right, guys. Hi, this is Joe Sardella, your trusted real estate agent. I'm here with my main man, Cash Nees, the best mortgage broker in town. Cash has so much experience doing loans for people. We've worked together on countless deals. And today we're going to be talking about down payment assistance and helping clients to be able to come up with the money to make buying a house possible. In today's price bracket, it's tough to be able to come up with some of these down payments that are out there, and there's so many unique ways to be able to do it. And Cash is the expert on all of this stuff, and one of my favorite ways that I want to get it out right away, Cash, I hope you don't mind, is I have a client who recently she had a great credit score, she had great work history, and a 401k, and something that we found out that she could do was actually for the down payment of her offer, she could take a loan from her 401k in order to be able to meet the requirements for the loan. And since she was a first-time home buyer, Cash will talk about this, but it was a 3% down. So she took a loan for 3% down from her 401k, and because it's her 401k, she was lending from her to herself, right? Yeah. So she got to pay herself an interest rate as opposed to paying a bank an interest rate, which was so powerful because she gets to basically continue to work, continue to deposit money from her checks into her 401k, and that money plus interest is going to her, which went to her down payment on her house. So, there's just so many creative options out there to be able to make the down payment. And if you've been struggling thinking about how it's possible for you and to get that kind of money, we're here to answer that question today. So, Cash, I've talked enough, man. Take the reins.
Yeah, no, I definitely think that, what your client did is very smart. A lot of people don't think that they can use their 401k or IRA or retirement funds or anything like that, for their down payment. And they also have been told that it's not a smart thing to do by a lot of people. We don't want to touch our 401k. There's a few advantages on touching your 401k. Number one, like you said, there's really two ways you can do it. First thing first, you always want to check with your provider on your terms of withdrawal to make sure it's possible. Sure. After you do that, you could take out a loan, right? Just like your client, take out a loan and then you pay yourself back interest. Usually it's a much lower rate, usually around 6 to 8%. And there's a bunch of great benefits of that. One of the biggest things is that as a lender, this isn't a loan that's going to appear on your credit report. So therefore, it's not going to be a loan that's going to go impact your DTI. Mm-hmm. In fact, there's a lot of creative things we can do with this as well. So most of the times when you are pulling from your 401k, you have to submit a request in order to pull that money. And then the 401k provider will want proof that you're buying a house. This is an exception that they make in order for you to purchase a primary home. That proof is usually going to be a loan estimate. And that loan estimate, what they're looking at is called cash to close. Mm-hmm. So many people get concerned with down payment, closing costs, but really what it comes down to is what's your cash to close. That's going to be your down payment minus your earnest money deposit plus your closing costs, okay? Now, one of the really creative, awesome strategies that I use with quite a few clients, whether it's if you're trying to get approved for more or just you want to get into a better situation, is that cash to close can include debts that we're paying off as well. So one really popular strategy is people who have credit card debt. They can pull money from their 401k. We can pay off that credit card debt at closing. So now you're eliminating an 18 to 25% interest rate on a credit card. And rather you're taking out a loan against yourself to pay all that off. So you're paying yourself back with interest. You're not paying the creditors. Super underutilized strategy that is amazing. I was going somewhere else with that. The other cool thing about
so many people from the debt traps of today.
Yeah, the other really cool thing about it is if someone can't qualify for the price that they want because of that debt to income, right?
Sure.
Then when we're paying off credit card debt at closing, we get to remove that debt to income, and you can actually qualify for a more expensive house.
Wow. Yeah.
No. And then when it comes to payments, it really ends up being a wash because you're eliminating credit card debt. You're replacing that. I don't care what Dave Ramsey says. I think there's good debt and bad debt, and you're replacing bad debt with good debt. So that's a really, really underutilized, very great strategy, is doing something like that. Another thing you can do This is one that isn't as advised, but if you need more than what you can get from a loan, you can do a hardship withdrawal. So you can do a hardship withdrawal from your 401k as well. On that, though, you do have to end up paying taxes. So consult with your CPA, your financial advisor. Obviously, we're not tax professionals, but that would be more of a last case scenario if you just needed the money for your down payment. But that's a great way. Other ways that you can come up with down payment is you always want to check for local grants. So there's two different types of assistance you can get when it comes to, forms of money. You can get a grant. A grant is something that is going to be, subsidized by either a local entity or a national entity. And then it's something that you don't have to pay back. So grants are absolutely amazing. Now,
we like free money, Cash. How do we get this free money grants? How do we get that?
Exactly. Free money, though, it comes at a cost sometimes, that's how we got into inflation and all that stuff, but we won't go there. But yeah, so free money is good because you don't have to end up paying that back. Now, you want to be very careful, though, because oftentimes they'll advertise it as free money, but you have to pay it back. And that's where it comes into like assistance, like down payment assistance and different things like that. One very popular program in California is called CalHFA. So that's a down payment assistance program. Now, with down payment assistance, usually you're going to have a second lien on top of your first lien. So your first lien is your mortgage, and then you get a second loan that's on the back side of that mortgage for the down payment and a portion of the closing costs. There's a lot of different options on what you can get for that.
How does that differ from, say, like a silent second? I've seen a couple listings out there that are maybe senior housing, but it's income qualified, where they can take a silent second that doesn't need to be repaid. I've seen a few listings out there.
So a silent second does have to be repaid whenever you refinance or you sell the property. A silent second means that it's not going to accrue any interest on the back end. There's no payments. You don't have to accrue interest. So really, as long as you're comfortable with your monthly payment, this is something that you could keep forever. And yeah, I mean, you do pay it back whenever you sell. Even if you passed away, then your heirs would be paying back that down payment assistance. But that's what a silent second is. There also are forgivable seconds. So a forgivable second is something where you keep the loan for a certain amount of time and then the second falls off. You don't have to pay it back.
Okay.
Now, when it comes to forgivable seconds, 9 times out of 10, your interest rate's going to be a lot higher because there's no free money. Sure. If they're not going to make you pay it back. They're going to get it back through that higher interest rate. So that's something to, be wary of. There's also, seconds that do accrue interest.
Cash, I'm just thinking about maybe the true first-time home buyer who, maybe is looking with their family for the first time, starting a family, that kind of stuff. They might not fully understand the word second. Could you kind of explain that? In the sense of what a second on a mortgage is?
Yeah. So like a second is going to be basically it's a second loan on the home. So you can have a second as a down payment assistance. If you have heard the term HELOC or HE-loan, those are going to be seconds, which is basically a credit card that's attached to your home's equity. So you have a first mortgage and then you have a second mortgage. That's what a second is.
Awesome.
And then, some programs as well, they will want you to share appreciation. Like there's the California Dream for All program that was very, big in the news and everything like that. And with that one, people could get a substantial amount of money to put towards their down payment to help with affordability. However, whenever you ended up, you're able to refinance one time with that program. But when you sell, you have to pay back the assistance that you got plus 20% of your equity.
Oh, wow.
So it seems great on paper, and it's good because it helps people get into a house because prices are so high. But I know you do too, like my biggest goal is to always set people up for financial success now and in the future.
Absolutely.
Like we want people to take their equity and upgrade, not have to pay it back, right?
Yeah. Well, and I mean, for the record, how many people actually end up following through with the whole 30-year loan process, right? And
very little.
And
close to
seems like
none, to be honest.
that government grant loan. It seems more like that's kind of the premise that it's on, that they're going to
Yeah,
take
I mean,
20% equity because you're going to be in it for
it
30 years.
definitely benefits them more than anyone else, because the longer you keep the house too, the more that 20% appreciation goes up.
Absolutely.
There's also, like, I think one thing that first time was, everyone always assumes there's free money. As we got into, there's very few things in life that are free, unless you can find a true grant. Now, the biggest benefit of being a first-time home buyer is you can purchase with a conventional loan with only 3% down. Yeah. Every other time with a conventional loan, it's going to be 5% down. So it's a lower down payment to get into that. Now, most programs are actually going to be income-based more than whether you're a first-time home buyer or not. So there's different programs like Home Possible or HomeReady. These are conventional programs where if you make under 80% of the area median income, then you get a benefit on your interest rate. There's also area-specific programs, such as the community lending program, which is nationwide, where this has no income limits. But if you purchase a home in one of these areas with a conventional loan, your interest rate is below market.
Yeah, no, absolutely. I was checking out that map the other day, and that there's a lot of opportunity in those community lending areas. Yeah. Maybe I'll have to include a screenshot of the map on the blog post. That way people can see that. But talk a little bit more about that too, because it is such a good program for people who are just getting into real estate and looking at that kind of those areas.
That specific one's nationwide. It's a Chase brokered program. So every bank has to give back to the community by giving some kind of special incentive to lower income or, rejuvenating areas. This program, there's areas that were discriminated against before redlining came out. And basically the government wants to revitalize these areas. So they are incentivizing the buyers to be able to purchase a home in these areas with below market interest rates. So usually the interest rate will be anywhere between 0.5% to a full percent lower. What's really cool is if you buy a home in one of those community areas, is the home is what qualifies. So no matter what your income is, as long as you can stay conventional, your interest rate is always that much lower.
Absolutely.
So that's really big.
Some of the areas in the Coachella Valley I know were in Indio. There might have been a couple in Cathedral City and in Desert Hot Springs. And I think there was some areas in Coachella as well too. And then San Diego, you can probably help me name some of them, but
it's basically everything south of National City. Really, it's pretty crazy how big it is in San Diego. There's a large area, but it is nationwide. So, I know Joey has some links, and then you can always check out the map for, different areas to see what qualifies, or reach out to us and we can look specifically at your area and tell you which areas qualify.
Absolutely.
Some other things too, I think would be important to just touch on if we're talking about down payments, is a lot of people often overestimate that you can get a gift from a family member when you're getting a down payment. So not everyone has the means for that. Not every family has those means, but that is a resource that some people are able to have. Is, a lot of parents, especially nowadays, a lot of parents have saved up for kids to go to college and stuff like that. Kids don't go to college as much. So maybe someone can get help with a down payment from a family member or a close friend or something like that. Another very popular thing too is called a gift of equity. So something else people don't know is if you're buying a home from a family member or close friend and they want to hook you up on the price, instead of them giving it to you at a discount, they can give you a gift of equity that we can use towards your down payment and closing costs. So for example, let's say you want to buy a house for $500,000, or you want to buy a house from your family member that's worth $500,000, and they want to sell it to you for $400,000. Well, rather than them doing that, rather than selling it to you at $400,000, they actually sell it to you at $500,000 and then gift you the equity, which is 20% that you put down on the home. The really cool part of that.
Let me just interject real quick. So, and that gift of equity, could it be used to also buy down interest rates? Is it considered a concession?
It's not a concession.
Oh, okay. Interesting.
But yes, it can be used. We can also add concessions on top of it.
I see. Yeah, sure.
It doesn't go into concession totals.
Okay.
So it's merely the gift. It's the down payment. So you could use it for down payment and closing costs, or, we can use it a ton of different ways. But that's also a great strategy, especially if people have a parent or someone, who really wants to give them maybe their family home and doesn't necessarily, need to sell it for top dollar. Give it to them, and then, you could end up buying the home with 20% down, so no mortgage insurance. We could buy down your interest rate, and then and we could cover closing costs so that you come to closing with no money.
Fantastic.
So that's a really great strategy as well. And then obviously having a great realtor that can help negotiate your credits also is very important.
I got you guys. Absolutely.
But yeah, I think if down payment is, holding people back, I find that generally during my conversations with people, number one, people are very surprised on what they actually qualify for and the programs that they qualify for. And then number two is all of the different tricks that we have to make sure that your monthly payment is at a place that, makes sense for you.
Of course. Cash, tell us a good feel-good story. I told mine in the beginning with the 401k loan. Tell us a story about maybe somebody who really didn't think it was possible and it ended up working out.
Yeah, no, absolutely. So I helped a client close last month. I met him 2 months earlier at a home education class. He was doing this home education class to really just sharpen his sword and learn about buying a home. Well, after my class, he had called me later on and he said, he liked it. He'd like to explore getting pre-approved. He met me at a coffee shop with his parents because he wanted his parents to co-sign. He didn't have any faith that he would be able to qualify on his own. After our pre-approval, it turned out he could qualify on his own for what he wanted to buy.
Wow.
So he ended up buying this house by himself. He was like 22 years old. And he didn't think that he could. Now he has his house without a cosigner. He also had a great real estate agent who helped negotiate him $10K in seller concessions that we were able to use for a 2-1 buy down. And then as well, this specific client, he qualified for a grant based on income and got an additional $2,500 that he was able to use for his closing costs or buying down his rate. So that was an awesome story.
What was the grant called, and how did he find out about that?
Well, he found out through his great lender, but the grant is called the VLIP grant. It's very low income.
Okay.
It's very low income program, I think is what it stands for. But essentially it's through Fannie Mae and Freddie Mac, who are the biggest aggregators of mortgages. That's who it gets sold to. If you make under 50% of the area median income for which you live, you qualify for this grant, which is $2,500. And what's cool about that grant is we can actually use it towards your down payment as well. Most assistance or different things like that, we can only use closing costs or something like that. That one we can actually use towards down payment, your rate, 2-1 buy down. We can use it however we want. So
can I ask you what profession he was in? I mean, you said he was 22. And so he had to have 2 years of work experience.
Dishwasher.
He was a dishwasher
at a restaurant.
You guys, if a dishwasher can do it, you can do it too.
Exactly.
I think that's a fantastic story about how it's really possible for everyone.
Yeah. And he just, he put all the pieces in order, and he was smart with his money. He had just a little bit saved, and we were able to make it work. I had another one. I mean, now I'm on a roll just thinking, but I had another one that actually used that strategy we were talking about. It was last year now, but they wanted to buy a home. They didn't qualify for it. They went to 2 other lenders who told them they didn't qualify. And for the amount, at least, that they wanted to purchase, they were looking around, they were getting really discouraged. And they're like, we can afford this payment, but maybe they just didn't show it all on paper and different things like that. So what we looked at is we were able to use their 401k to pay off debt, qualify them for a higher amount. And they were able to buy this home with a 2-1 buy down and get into a great situation. But they got told by 2 other lenders they couldn't do it. And it took like some outside the box thinking about like 401k and paying off debt to get them to the goal that they wanted. So
that's awesome.
That was super cool too.
Working miracles, my friend. Yeah.
Well, another thing too, while we're on it, my last thing is if we have any first responders, medical professionals, or educators, and then I've recently opened it up to nonprofit workers as well, is I have a hero program where we give $1,000 back to all those people in the form of a lender credit. So we can't use that to toward down payment, but it can be used towards closing costs or buying down the rate. And I have a lot of great agents, wink, wink, who also will match that credit
Absolutely.
for those professionals. So you get a $2,000 credit that we can use to buying down your rate, taking care of closing costs, all those different things. So
absolutely. No, we're very grateful for those first responders and heroes out there, and want to do the best that we can to support them in business. Cash, thank you so much for your time. This was so educational. I know that people are going to love this video. They're going to love the blog post that comes along with it. And we got to do way more of these, man. We should be doing these maybe every week, maybe twice a week, man.
I'm down.
This is fun. I'm having a blast with this. This is awesome.
I am super down. We could do this every single week.
Yeah, man.
Absolutely. Start a YouTube channel.
All right. Now, how can people find you other than going to my website and applying for a loan?
All social media websites, you can find me as Cash Loans. It's spelled like my name, though, CACHE Loans. Mm-hmm. So that's what I'm branding for myself. That's what I've branded since day one. And I was born for this industry. And that's how people can find me, stay connected with me there. I also have a newsletter and always just trying to stay connected and educate clients and individuals to make smart financial decisions regarding real estate. So
awesome.
That is that. But cool. Well, we'll definitely have to do this again, bro.
Absolutely.
It was super cool. And I think that we could just ramble on and on about a bunch of different topics. So
absolutely. Yeah, no, I'm looking forward to the next one, buddy.
Sweet. Awesome.
Right. Talk to you soon.
All right. Thanks, bro. Bye.
Bye.